investors in mutual funds are realizing that we are going to be in for a little bit of a turbulence going ahead, despite the fact that we have had a very decent rally and we have retraced almost 30% of the decline. I think everyone knows that we are not out of the woods, are paying much more attention to their overall equity proportion in their investments. If you look at someone who is working in industry which has been directly impacted by COVID, for example, if someone is working in hospitality industry or aviation industry, and if they are running a portfolio of their investments, which is 70-80% into equities, I think there is a need for caution. So they need to conserve savings, horses for courses. Similarly, if someone is working in FMCG industry or IT industry, I would think that the income profile or the salary outlook for those kind of sectors are pretty stable. I would not mind that investor to be really more than 50-60% in equity. Starting point has to be, what are your level of savings? What is your job security? Where are your savings where are your savings today, currently? And do you need to realign your equity proportion of the investments or savings? Given the level of uncertainty which we are still contending with, my own advice today would be to go for a diversified large and mid cap kind of a fund. The reason I would say that is because that's an all-weather fund. Right now we've had 3-4 good weeks. It's very, very likely that we'll have 2 bad weeks. But the question is, what do you do then when you have a bad week? I would strongly recommend put it in a staggered manner, because that next 3 to 6 months will be volatile. I mean, you will have bad weeks and you will have good weeks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.